Hello, good afternoon, and welcome to MF Corner on CNBC-TV18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. Now, with the Reserve Bank of India cutting repo rates by 25 basis points and shifting its policy stance to accommodative amid this global uncertainty that we're seeing, debt mutual funds are back in the spotlight for investors. Today, we'll be exploring how this policy shift impacts the debt funds in terms of strategies that you should follow, whether aggressive rate cut bets are justified, how to balance your risk and opportunity in such an uncertain time. We are joined by Kavita Menon, who's the founder at Proboscis Wealth, joining in with us to talk to us about all of this and help you all understand what you all should be doing now with your debt mutual fund strategies. Kavita, thank you so much, as always, for joining in with us, and a very good afternoon to you as well. Let's just start by the basics about what should your mutual fund strategy be now. RBI has cut that 25 basis point rate. They've changed the stance as well. So is it the right time actually to invest now in debt funds or increase your exposure toward debt funds?
So, hi, Vinnii. Thank you for having me here. Always a pleasure to be here. So, yes, RBI's rate cut has led to a rally in the bond prices. Already, yields have come off, and those who had positioned themselves in long duration bonds before the rate cut have seen a real significant appreciation in their portfolios, in the bond portfolios. Now, having said that, the RBI has also, given an indication of further rate cuts in this financial year itself. So, given this reality, those who have, I would insist the words should be savvy investors. Okay, people who understand the bond markets, they would do well by positioning themselves in long duration portfolios. It could be typically gilt papers or even a mix of corporate and gilt would be good. But with longer durations, because typically whenever interest rates come down, these long duration funds tend to give superior returns. However, again, this is because I'm an investment advisor, I am compelled to give you the risk factors also. The fact of the matter is that inflation is always a very important criteria in RBI's monetary policy. Okay, and it has been very proactive when it comes to managing inflation. Now that inflation has come down, there is a lot of space for the Reserve Bank to reduce interest rates. So it looks like in the next 6 to 9 months or 9 to 1 year period, there could be rate cuts and therefore an appreciation in bond prices. However, this is going to be accompanied with volatility given the global conditions we are in. So, volatility means there could be very severe price up and downs. If one is ready to absorb that, then this is a great time to be in long duration bonds.
In long duration bonds, but be prepared for volatility is what you're highlighting as well. So that is a key cursor that we should keep an eye out on. That volatility will be there, but if you have just a 6 to 9 month, 1 year time period, long duration is what you could look at, but be prepared for volatility. Okay, what if I am already holding some bit of a debt fund? Anything I should do in terms of changing the strategies? How does that work over there, given this current scenario that we'll see?
So typically, yeah, you have in investors, you have two type of investors. One who buy and hold. Okay, they are long only kind of investors. For them, I don't see a big change in strategies anyway is going to work, because remember, every time you exit out of your paper, let's say because now you're sitting on a big gain, you're looking at, some of them are looking at double-digit returns. Okay, let's say you want to book out and then you want to look at reinvesting, then you have a reinvestment risk now, because now the yields are looking lower for long duration papers, right? The yields have come up, prices have gone up, but the yields have come up, right? So for those who have already invested in these long papers, I would suggest hold on. There is still a lot of steam left, so please hold. While those who are looking at investing in it for the next few months or a year or two, then I would suggest you get in, but with the understanding that there will be ups and downs. There will be volatility.
Okay, Kavita, can you just elaborate a bit more? Like, what I want to also understand with US Treasury yields coming into play as well, they're seeing a bit of a rise. Global economic uncertainties that we're talking about. Indian debt market, how is all this going to be impacting that, and in turn your debt funds? If you could just break it down for our viewers, in case if someone doesn't know how this process works, I just want them to understand how debt funds work then.
So very typically, Yeah. Whenever the RBI has a very dovish or accommodative stance, it starts cutting rates. Bond prices should start rising. Okay. But bond markets are just like the equity markets. There is a very vibrant bond market and trading happens on a daily basis. And there also the demand supply situations change daily basis news flows. Okay. So really speaking, while India looks great from the debt point of view, like I said, long duration bonds are looking great. And I kept emphasizing on volatility. It is really because the global situation is so uncertain. There is so much news flow happening on a daily basis. Not all of it is positive. Okay. And what happens is, so just to give you an example, when Trump announced his policy, his tariff policies, bond yields just went berserk globally, so bond prices fell. It's an inverse relationship. When yields spike up, the prices fall. And that volatility we saw here in India also. हमारा कोई उतना लेना देना नहीं है उनके साथ, but we cannot escape global volatility. If it is there, it's there in our portfolios as well. Okay, so which caused a correction in the prices of bonds here also. However, if you look at the term, the direction, the trajectory is that we are going to see rate cuts in the future. So the trajectory is that you're going to see lower rates here in India, right? But global factors, global uncertainties will keep playing, and therefore there will be volatility. If one is okay with the volatility, see, generally what happens is debt investors tend to come with a point of view that they want safety. They come with the mind frame of wanting safety.
True.
So if you don't understand that in bonds also there can be this lack of safety. It's not actually
Yeah.
a risk of capital. It is a volatility, which is the nature of the way bonds function, the market functions. So if you don't understand that, and then suddenly you see a fall in your
Yeah.
capital, which is also possible, then and you don't understand it, then I would not suggest that you go with long duration funds at all. Then you don't play the interest rate game at all. You're better off being invested in short duration funds. The shorter term, because there is no much interest rate risk, and you're pretty much going to be comfortable because the volatility is very limited.
Kavita, actually, my next question was on that only for investors, maybe who have a low risk appetite, right? Even though debt funds is less risk already, but lower risk that one could want or doesn't want to take that much. And like you're mentioning, don't go for long duration funds. Then what specific kind of debt funds can one go for, right? There are so many options there as well, short-term corporate bond funds and portfolio duration also. I want to understand how important is that going to be a factor as well if you have a lower risk. How much of a time period should your duration be in this current scenario then?
So let me define duration in the simplest possible manner. Okay, it is the average of all the cash flows of the portfolio. Let me put it like that. It's the average time frame of all the cash flows in that portfolio. Okay, which means that a longer duration means most of the cash flows will come over a longer period of time. Okay, a shorter duration means the funds cash flows have a very close, payouts will be much closer. Closer payouts or closer duration means lower risk in the portfolio, interest rate risk. Let me put it like that. It's lower interest rate risk. So if let's say I have a requirement of money in a 3-year period and I need to invest in a bond fund, then I should look for a fund which has a duration of 3 to 4 years. If I am okay with investing in a 10-year period, for a 10-year period, then I could look for a portfolio which has a duration of 10 years. Basically, as an investor, I need to match my requirement with the duration of the fund. Okay, that's a very good way of managing interest rate risk. If you don't want to play any interest rate risk, there are options. You can stay in very short duration funds. You can play arbitrage. Okay. You can also there are other opportunities in the short term. There are liquid funds. There are short term funds. There are mix of arbitrage and debt funds, which have just 2 or 3 years period duration, and that works very nicely for investors who are risk averse. Okay. For somebody who wants a little longer, you can also go for corporate bond funds. You can go for credit opportunity funds. But there is a credit risk
Yeah.
there. although limited and managed by the fund managers very well in India,
Hmm.
but still those risks have to be known to the investors. Typically, if you don't want any risk, you will be mostly invested in a treasury, guild
Yeah.
kind of a combination.
Sure. Kavita, now I have to pick up a fund, then debt fund. As a debt fund investor, what are my key indicators that maybe I could look at while picking up the fund as well, right? What should an investor watch out for? What should they monitor before making a decision for debt funds specifically?
So the first thing is the most important thing is matching the tenure of your requirement with
Hmm.
that of the duration of the bond
Hmm.
portfolio. It's a very
Right.
important thing. If it is mismatched, you will be exposed to interest rate risks, okay, or reinvestment risk, or somewhat one or the other risk is there in the portfolio. So ideally, most advisors will ask you to match their requirement along with the tenure of the fund. In fact, even if you have a longer period, there are investors who have been invested in short duration funds for the last decade. And that's because they don't want to take that interest rate risk at all. They're okay playing the shorter end of the yield curve, okay, because they don't want the risk. So so based on your risk appetite, the tenure of your investment is a very important criteria. The second criteria is you can select between passive and actively managed funds. Passive is simply your, funds like your Bharat bond ETFs, where they just buy a portfolio of bonds and keep it till the end of that period. You can buy it and you don't do anything. You can, although they are liquid, you can trade in them in the market, but you don't trade in it. You just hold it to maturity, and thereby whatever is the yield to maturity of that portfolio, you will get it. This is a passive style of investing. You can also buy gilt funds which are having fixed term, okay, so that is passive. You can have actively managed funds where a fund manager is taking the decisions on your behalf. Even liquid funds are managed by a portfolio manager, okay. They will come with slightly higher expense ratios, so you can have a look at that also, what matches your requirement, whether actively managed funds are good for you or passive funds. Like I said, if you have a 10-year vision, then a gilt fund, which is say maturing in 2035, a gilt ETF can work for you. Okay, something like that. Then the third thing that you need to look for is the credit risk in the portfolio. Now, while liquid funds, short-term funds generally invest in very highly rated gilt and PSU bonds, they're all AAA rated. You have various others also where the yield is slightly better because they invest in less than AAA rated quality. You have corporate bond funds, you have credit opportunity funds. You could look at these. These have slightly longer duration, slightly better returns also, but they don't have all AAA rated or absolutely safe kind of investments. They will have lesser ratings also. Have a look at the ratings and see your comfort levels before investing in these funds. Okay, so credit rating, ये
Hmm.
बहुत जरूरी चीज है.
Okay. Right.
Okay, you can look at that. And there's a last one, which is taxation, especially when you're
Okay.
investing in mutual funds. There are funds where you pay 12.5% taxes. There are funds where you may pay at slab. So you need to see which funds match your tax. Post-tax returns also is something that's important to look at.
That's very important as well. So yeah, everyone wants to save tax as well. So that's an important one for me in terms of priority also that comes in over there. But Kavita, thank you so much for explaining us this debt fund as well. But on that note, we're going to sip into a very short break, viewers. We'll be back and we'll be talking about gold ETFs and gold mutual funds. What's the story there? So stay tuned in for that. Welcome back and thanks for staying tuned into MF Corner on CNBC TV18. We still have with us Kavita Menon of Probithis Wealth here to talk to us about what's happening in gold mutual funds now. Given that gold has hit that all-time high, every day you see new high levels coming in. Should investors add more in terms of gold ETFs or look at more in terms of gold mutual fund, or should they start booking their profit? What is the best strategy right now for you as an investor in gold mutual funds and gold ETFs? Kavita will be talking to us about all of that. Kavita, I'm going to talk about this itself, right? Because I'm looking at the numbers when I'm seeing it in terms of the return. Gold overall has gone up around 30, 39, 40% in this last 1 year, approximately that level. We've seen ETFs also, right? I've picked up certain funds that I'm just looking at. So SBI Gold ETF or HDFC Gold ETF, around 30, 31% returns is what they've given in the last 1 year. What is your thought now coming in terms of for an investor who has made so much profit, should you actually start booking a bit of this profit as well? Because I was looking at the AMFI data also this time and seemed like that gold ETF has seen a bit of a reduction and gold mutual funds are seeing that reduction coming in. Is it time to book your profits and maybe just hold on now to some bit of a cash on that front?
So, the thing about gold is that its purpose in your portfolio is really not getting you those returns. It's a hedge against inflation. And because there has been so much uncertainty post-COVID, that is why you've seen a rally in gold prices. Now, my own opinion is that gold has to be a part of your portfolio. There is no two ways about it. Anything between 5 to 10% of any investor's portfolio has to be in a commodity or here typically bullion, which is gold. It has to be there. So if you have no requirement of that money, I don't see any reason why you should book out of gold, because I personally believe that uncertainties are only going to increase in the coming years. And everybody will need, see, why do we keep debt in the portfolio? We keep it for safety, we keep it for emergencies, we keep it for utilizing in case of opportunities, isn't it? Similarly, gold has the function of giving us safety when everything else is shaky, and that's why you need gold. So therefore, to all investors who have made tremendous money in gold, unless you need the money or you have completely overshot your allocations, asset allocation, I don't think you should be booking profits and getting out.
Okay, don't book your profits because it's a hedge that comes in as a bet for you when you're holding some bit of a gold. And the allocation also is what Kavita has mentioned, how much you should have. It's yes, over allocated, then maybe book some profits and enjoy some bit of that profit on that front, but otherwise continue to hold it. Kavita, what I want to understand, right? We have two options. Gold ETFs also come in and gold mutual funds also come in. One, what should you pick? If I want to invest right now, does it make sense to enter one of these? And what is the difference that one should be picking between both these?
It's they both underlying. See, the underlying of both these structures is gold. Okay, one is purchased and sold in the markets, just like you buy and sell stocks. Okay, gold ETFs. They are bought and sold. They're very liquid. You get intraday prices also of gold. Okay, so it's very much like a stock. So if you are very comfortable buying, selling in the market, you can place your trades with gold for gold ETFs also, provided of course you know the mechanism of buying ETFs. Okay, uh, gold mutual funds on the other hand are just like your plain vanilla funds which you buy through your through directly from the fund house at the closing NAV. Just like you buy your normal equity funds at the closing NAV, gold ETF also you can purchase at the closing NAV. The main difference is that ETFs give you intraday liquidity. Gold mutual funds don't give you intraday liquidity. They have daily liquidity, but it's not intraday. And of course, there is an expense ratio which is slightly higher in the case of funds. In ETFs, the expense ratio is lower. This is the main difference.
Okay. Uh, Kavita, uh, in 2025, what should the strategy be? ETFs or gold mutual funds? Kavita?
Completely depending on the clients. I know Sorry, can you hear me?
Yeah,
Am I
I can
breaking?
hear you. I can hear you now. Yes.
Okay. So completely depends on the client's requirements. If a client is savvy and can buy and sell intraday in the market, then please go with the ETF because it's a cheaper model. But there is again brokerage you must be aware of. You should know what you're paying when you're buying and selling. On the other hand, if you're not very savvy, don't have a demat account, then buy the mutual fund. It's an easier option. You can buy it like any other mutual fund that you hold. Completely, I'm agnostic to it. I'll just ask the client what he's comfortable with, and he can go with any of the two structures.
Absolutely makes sense as well. Kavita, anything specific that you look at in terms of gold mutual fund? Anything you could recommend to our investors as well, gold mutual fund or ETF side, or any recommendation on there?
Sure. In fact, you just showed a screen with the returns. Okay, and one of the schemes seem to have a slightly better 1 year return compared to the other two, right? how is that possible that they all three of them are having the same product? The underlying is gold, but how can the returns be different for each of these schemes? The reason is the expense ratios and the tracking error. Okay, so when you choose funds, please look at tracking error and look at the expense ratios. This will give you an indication of which fund to choose amongst so many that are available in the market.
Okay.
Okay, that impacts your returns.
Okay, that surely does impact your return, and keep an eye out on that when you're picking up your fund that you want as well, because underlying is the same. Only that makes a difference in terms of expense ratio as well. Just in a volatile market, how much allocation did you mention that one should have as in their gold or a bullion side of commodity side of investments?
So ideally, from an allocation point of view, I personally offer anything between 5 to 10% in gold to my investors. But again, this is up to the client. If they want allocation, I would like to have it in a range between 5 and 10, because more than that, one must remember that gold doesn't, it's just an asset which doesn't have any cash flows. It doesn't give you any real income, right? So it's just a hedge. So about 5-10% in between this, it is up to the client to decide what he is comfortable with. But I think your viewers should at least keep a 5% allocation. It's a minimum in commodities like gold.
Minimum in commodities like gold is 5% allocation, at least, is what you should have. And even if you're making profit on this one, this is a hedge that you're making. That's what Kavita started with as well. So yes, if you are holding about 10%, maybe you can look at booking your profit, but otherwise continue holding gold. It'll always protect you in terms of hedge from the volatility that is there as well, plus safe haven demand. So nothing wrong in that terms. But Kavita, thank you so much, for joining with us on the show today. It's a pleasure having you on understanding debt funds as well as gold, mutual funds and ETFs, what our investors should be looking at. And with that, we'll wind down this edition. Thank you so much, viewers, for tuning in to MF Corner on CNBC TV 18. But up next, you have Closing Bell to take you to the last hour of trade.